So I see that we already have a lot of participants in the meeting. So hello and a warm welcome to today's webinar. It's the second webinar in Solactive's ESG 2021 autumn series. So thank you for taking the time today and being here with us. I'm Jennifer Nerlich, Vice President at Solactive Strategic Initiatives team, hosting today's webinar and taking care at Solactive of the ESG projects and efforts. Last week, we started the series together with our strategic partner, Minerva Analytics, focusing on sustainable stewardship practices in securities lending. The video is available on demand, so if you're interested, please feel free to send us a request. We are happy to share the link. Today, we are focusing on another exciting topic, achieving impact by investing in carbon allowances. I'm joined today by Jan Ahrens, Head of Research at Spark Change, a real expert in the field of EU carbon trading schemes. So let me shortly introduce him. Jan is a seasoned carbon market analyst covering the EU ETS system and policy since 2006. After working at a major emitter and at a carbon trading company, he has built his own data and analytics business, supporting and advising utility companies, oil managers, but also financial institutions and the regulator on the EU carbon trading scheme. He held internal workshops at the EU Commission and acted as an expert in the market stability reform for the EU Parliament. He's also a special advisor on the carbon markets for an Australian-based university and well equipped to guide us through this complex topic today. So welcome, Jan. Before I now hand over, let me shortly give you some information on the housekeeping items. The webinar will be recorded and made available on demand. So for today's session, we structured it into two main parts. So first, Jan will give you a short presentation on carbon allowances, providing you information on the mechanics and also how you could achieve impact by investing in EU allowances. Afterwards, we will run a live Q&A session. So we have enabled the Q&A field at the bottom of the screen. So please feel free to share your questions in the Q&A section so that we can answer all the open points in between or at the end of the session. So let's get started. Mitigating climate change is one of the greatest challenges we are facing today. To incentivize the transition to net zero, policymakers have various tools. One of them is the implementation of emission trading schemes. So with the EU emission trading schemes, we have the oldest and still operating trading scheme here in Europe, which regulates the emissions of heavy emitters. And without going into any other detail, I'm handing over to Jan to show the presentation and give you an introduction into this exciting topic. Jan, over to you.
Great. Thank you, Jennifer, and thanks for having me. So today we speak about regulated carbon markets. Let's just distinguish this really quickly from offset markets. Offset markets are voluntary markets that are set up where companies voluntarily can buy carbon credits and retire them. Today, we speak about a different market, a cap and trade market. These markets are set up by governments to regulate emissions and drive down emissions over time. So let's look very briefly into this, how this works. If a government has an emission reduction target, for example, to reduce emissions by 50% through 2030, they will try to reduce emissions over time. And every year, they hand out a certain amount of permits to pollute. These are carbon allowances. One carbon allowance allows you to emit 1 ton of CO2 to the atmosphere. Every year, companies that are covered by the system need to hand in these allowances against all their emissions. They don't do it, they face a penalty and still need to surrender this allowance later on. So compliance is virtually 100%. Now, because emissions should go down, every year the regulator hands out less and less and less of these allowances. Some allowances are handed out free of charge to reduce the costs on some companies, but the majority of these allowances is usually sold in auctions. And make no mistake, these systems are primarily there to reduce emissions, but by now they are quite good resource of revenue for governments as well. And overall, as less and less permits become available, the pool of allowances that polluters can buy from obviously gets smaller. The less permits to pollute are there, the less pollution can happen. And over time, emissions go down. This is how cap and trade markets or emission trading systems work in a nutshell. Now, let's look at how exotic this market really is. Because while it used to be quite a niche market, by now, more than 20% of global greenhouse gas is covered by carbon pricing. There are 31 different emission trading systems out there, spanning from the US, South America, Europe, Asia, and even Australia and New Zealand. Each are different. And the one we're speaking today about, as Jenny alluded to in the introduction, is the EU emission trading system. It exists since 2008, covers around 40% of the EU's emissions, and is by far the most liquid market for carbon allowances. It trades at around 200 billion market size, at least that was the number for last year, covers more than 13,000 entities, has a trading volume of around 2 billion euros. So this is no longer a niche market. It's a massive market that is traded, and therefore it's an interesting asset. Because these allowances that are handed out, they're called EUAs, EU allowances, are traded on a primary and secondary market. Now, polluters can buy these allowances in daily spot auctions. Almost on a daily basis, these allowances are made available from the governments and polluters can buy them. Then there is a secondary market for these spot allowances, but most importantly, there is a very liquid futures market around this, trading derivatives, futures and options on this market on a continuous basis, mainly on the Intercontinental Exchange in London. There's also a subset on the EEX in Germany. So this is an interesting asset class, right? But so far it was really difficult to access. The only existing access options at the moment are based on future-based strategies, essentially using the futures on the Intercontinental Exchange to build an ETF-like product. The downside with this is it's pretty expensive because carbon allowances always trade on contango. And the reason why Spark Change exists is to make this better. We are building a product that is backed by an underlying physical emission allowance, which means that our exchange-traded commodity has no roll cost included. It's much cheaper compared to any other option. And most importantly, it takes allowances out of the market. Because if you are buying this security, we buy a physical permit to pollute, a physical emission right, an EUA, lock it up in our registry account so it's no longer available for polluters. And that creates impact. Before we talk about impact, let's look into this asset as an asset class. How does it perform? How does it behave? I already said the market characteristics are that by now the EU ETS is a pretty mature market. It's fourth iteration. It exists for more than 13 years. It covers a pretty broad amount of companies. It's mainly covering from the compliance side utilities, steel, cement sector, the chemical sector, oil and gas, and aviation. So flights within the EU need to surrender emission allowances for all the pollution they do in the European sky. Going forward, it will be expanded. Maritime transport will be added, and the EU will add a separate emission trading system for road transport and district heating. So this is the cornerstone and the key element of the European strategy to achieve their ambitious 2030 emission reduction goal. And this reflects in the returns over the last few years. So when you look at the EUA as an asset class, it's one of the best performing commodities over the last few years. Annual returns are stunning over the past few years. And what's also quite important is that even though the volatility of the standard deviation is quite high, it's an uncorrelated asset class. There's really low correlation to any other asset class, simply because it's primarily driven by, on one side, GDP emissions, but more importantly, regulatory ambition. And this has gone up significantly over the last 5 years. Now, this is it as an asset class, which is a potentially attractive financial instrument to take a position on a more ambitious climate policy going forward. But there's an impact story of buying and holding these emission allowances as well. I will, however, pause briefly to just check if there are any questions already coming in to this first section about how emission trading markets work, where they are operating, and how these allowances as an asset class perform.
So at the moment, we see not yet a question in the Q&A, but I guess they will come in over the next few minutes.
Great. So please use the opportunity to ask questions in the Q&A section below. I will move on and talk about impact, and then we have a longer period in the end where we can still take questions as we go. So let's zoom out for a minute. And before we talk about the opportunity here, I want to scare you a little bit. If we sum up all commitments under the Paris Agreement of all nations and countries out there, despite the fact that you have all heard about the great net zero targets and how fast they want to decarbonize by 2050, if we all sum up all these emission reductions and commitments, we will see something like this. This red area indicates the range of commitments of nations. And if you look at it from a quantitative basis, it shows that political leaders think it's a good approach to increase emissions by 5% over the next decade. Despite the fact science says we need to reduce really, really fast now, reap the low-hanging fruits, get early action, get moving to achieve, to keep climate change in check, politicians think we should increase emissions even further, and the future generations will not only deal with the consequences of our inaction, but also need to clean up the slack. If we would do this, we will actually use up 80 to 85% of our emission budget we have through 2050. And let's face it, this is political failure. This is nowhere near where we should be going, and this is just not taking it serious. So what can we do? If you translate this picture into an emission trading system, it means that you hand out way too many permits over the next 10 years, and then all of a sudden you barely hand out any allowances anymore as of 2030. You can see immediately that this is inefficient. So one thing you could do is simply take out emission allowances now, reduce the budget that's available now, hold it for a limited period of time, and then in, say, 10, 15 years, sell it again. This would rebalance the path. We would have less budget available for the next 10 years and more in the future. The overall budget wouldn't change, but the intertemporal efficiency would increase. We get a higher carbon price now. It would incentivize more investment into carbon reduction technology. Technology cost would come down. It would make the overall transition to net zero much cheaper. So that's a nice benefit of buying and holding emission allowances. We are simply delaying or changing the balance between the two carbon budgets, therefore putting front-loading ambition, putting more pressures on companies now, reaping the low-hanging fruits, and then when the market has not a lot of allowances left, alleviate that pressure a little bit towards the back end. That works in every single emission trading system that's out there. Every system has pretty similar pathway, not too significant ambition through 2030 and then a massive increase post-2030. But in the EU ETS, there's a kicker, because the EU ETS has a unique mechanism that no other system in the world has, and it's called the Market Stability Reserve. And it will take a few minutes now to walk you through the mechanics of this reserve, but it's quite important that you stay with me because it opens up a beautiful use case for using carbon allowances to create emission reductions. So how does the Market Stability Reserve work? The Market Stability Reserve was created as an answer to the past problem of the emission trading system, which was becoming very clear after the global financial crisis, where emissions dropped sharply due to slow GDP slowdown, but the amount of allowances that were handed out on an annual basis were still going strong as if emissions didn't change. So there were way too many permits handed out, carbon traded at a price of less than €3, essentially rendering the system more or less useless. And it was almost a lost decade because not significant emission reductions were driven. So the regulator responded and created the Market Stability Reserve, which is automatically adjusting supply based on emissions. How does this work? Every year, the Market Stability Reserve assesses how many allowances are in circulation against the emissions that are matched against them. And if this surplus, the surplus is called TNEC, total net allowances in circulation, exceeds a threshold of 833 million, 24% of this surplus are deducted from next year's auction volume. Now, let me say that again. So if the market is oversupplied by more than 833 million allowances, next year's supply of additional allowances is curbed according to the surplus that's still in the market. When we had COVID last year, emissions went down 30%. As of September this year, we're experiencing more than 300 million reduction in auction volume compared to the previous year, or compared to what was planned, not the previous year. So where do these allowances end up that were otherwise would have been auctioned? They come into a Market Stability Reserve. And this reserve and this one, they sit. However, as of 2023, the allowances that sit in this reserve, except for residual load, will be permanently cancelled. So the rules are about to be changing, but essentially what it says is there should be a residual amount of allowances left in the MSR, but any new allowances entering to this reserve in virtually all cases will be cancelled. And how does this work if you now invest into an emission allowance? When you withdraw an allowance from the market, if you take a permit to pollute away from a polluter, emissions will reduce because there's a permit less to pollute. If emissions reduce, but at the same time the allowance is still in the market, the surplus in the market increases, the TNEC. And as long as the TNEC, the total allowances in circulation, are more than 833 million, 24% of this emission reduction will be withdrawn from next year's auction supply, which again will create further emission reductions, increase again the TNEC, and so on and so forth. So as long as you hold these allowances, there's a virtuous cycle that is creating lasting emission reductions while you hold these allowances. Now, this sounds quite cool, but it's quite complicated. So let me explain it again in a different way. Let's make an example here. Very stylized example. In the first year, you have the regulator handing out 3 EUAs, and against those 3 tons of CO2 can be emitted. The market balance change, 0. 3 EUAs, 3 tons of CO2, 0. No change in the market balance. Next year, an investor buys an emission allowance, and someone can no longer pollute. So there's a reduction of 1 ton of CO2, but the allowance is still in the market, which means the market balance changes and increases by 1. The 3 EUAs out there, but only 2 tons of CO2 that were emitted. Now in the next year, no longer 3 allowances will be handed out, but only 2.76. Thereafter, so in the third year, however, 2.76 allowances are handed out and 2.76 tons of CO2 are emitted. 0.24 tons are no longer happening because the allowance is not handed out. So the market balance change in that year is again 1. Overall, cumulatively, the market balance is still at +1. Now, every single year thereafter, this process repeats. As long as you hold your allowances, the market stability reserve, as a direct consequence of your investment, cancels allowances and subsequently reduces emissions. And here's the kicker. In the last year, you divest your allowances, and an additional EUA comes back to the market, and a polluter can pollute 1 ton of CO2 against this. Now, what does this do to the market balance? There's now an additional ton of CO2 emitted without an additional EUA out there, because the EUA was always out there, was just locked up by you. So the market balance change is -1. If you now sum it all up, we're back at 0. The market balance change overall is back at 0, which means the effect stops, but it doesn't reverse, which means that during your holding period, you have created lasting emission reductions because the allowances for which you triggered the cancellation will never come back. Yes, there is a mechanism in place in the market stability reserve that allowances can flow back to the market, but only the ones that are in the residual amount of the MSR. The allowances that were cancelled, they are not coming back. So even though you're divesting from your EUA and this additional ton of CO2 that you have created in step 1 is now coming back to the market, during your holding period, you create like a climate dividend. Every year, your investment created an emission reduction. The longer you hold it, the bigger this emission reduction overall that accrues over time. And then in the end, when you sell it, it remains. So what this means is you have an asset that is no longer requiring you to retire it, but it's like an emission reduction project. You buy it, you hold it. During its holding period, you create emission reductions. In the end, you can sell it potentially at a profit. Think of it like a forest. You buy a forest, it creates emission reductions during the holding period, then you sell it again. So it's an asset that is an investable asset that creates emission reductions. Unlike an offset that is a cost that you need to retire and the value is gone, in this case, the emission allowance can be held as part of a portfolio. It can be very easily calculated how many emission reduction it creates during its holding period. And then once you sell it, divest from it, the emission reductions remain, and you can potentially even make a profit. And this in a market that is regulated, verified on an annual basis, and is happening in where you operate and not in some other developing country or something.
Maybe one question on this, which we received, and I'm also quite curious on hearing your answer on this. What is the regulator thinking about the investment into this? So you described it just that you can invest in this. Is the regulator having a view on the investment?
So it's a very good question. We should, and I break this down a little bit, because first of all, we should think about what kind of investment is this. This is a buy and hold strategy. And you do this buy and hold strategy if you think an asset is fundamentally undervalued and think prices should be higher. So does the regulator want a high carbon price that reflects the long-term ambition? Yes. Does the regulator think that that the price at the moment doesn't reflect the long-term ambition? Yes. There are multiple statements from the European Commission saying that prices are still too low, even though we're trading at 65 euros at the moment. The impact assessment of the European Commission says prices should trade around 85 euros by 2030 to deliver the 55% emission reduction target. And analysts basically agree that this is the price that makes sense. Now, why do you want a high price now and not a gradual increase over time? Building emission reduction technology takes time. There's one case where SSAB, the Swedish steel maker, built the first low carbon steel plant. And it took them about 6 years to build and to produce the first ton of CO2. So it's not enough to have a high carbon price in 2030. The earlier we have a stable, sustainably high carbon price, it's a clear investment signal for companies to invest in decarbonization technology. Therefore, the regulator is quite happy with long-term buy and hold strategies that make sure that the price is rather stable at a high level that reflects long-term ambition. Now, what the regulator is not so happy with is short-term hedge funds driving excess volatility. The regulator wants a stable price signal and no excess volatility in the market. But a hedge fund wouldn't use a physically backed, long-term oriented product. They would use derivatives. And therefore, the regulator is quite welcoming to such a buy and hold strategy. Now, just to put this out there, this is not universal. There are countries and companies that don't like this. And these are usually companies or countries that have a bit stuck their head in the sand so far, I would say. So that haven't reacted for the last 15 years, didn't really care about decarbonizing their stack or cleaning up the power generation, and they now feel the heat. Well, you can make up your own mind whether this is a good thing or a bad thing, and I leave it at that.
Thank you. I'll let you continue first with the next slides before we go into the Q&A session.
Perfect. So now, as I said earlier, right, you can calculate based on which EUA or how many EUAs you're holding, how many emission reductions you create over time. And we've built a tool for this and teamed up with Solactive to use this as an overlay for equity indices. In fact, you can do it for any kind of investment portfolio, be it equities, fixed income, whatever. As long as you calculate the carbon footprint and have a strategy of how you want to decarbonize, you can use this tool. One word of warning, though. This is not the silver bullet that will get us to net zero in happy days. This is a transitionary tool that works in a limited period of time. At the moment, the TNEC, the total net allowances in circulation, the surplus stands at 1.6 billion. The MSR every year takes a significant amount of allowances from that market. At some point, the MSR will stop operating when the market is tight again. So this doesn't work forever. It works for the next 5 to 8, maybe 10 years. Therefore, it's a great transitionary tool. We are not advising now that you're simply doing nothing with your equity portfolio and just sitting back and relax while the UAs clean up your act. No, absolutely not. But you might have 2025 emission reduction targets in place that you try to achieve by structurally engaging with your companies, changing the structure of your portfolio. But all of this takes time. So you can sit there and wait and hope that your companies move fast, or you can be proactive. You can now buy emission allowances to trigger emission reductions while you are structurally cleaning up your portfolio. And once your portfolio is cleaned, you can sell the position again. So you're just showing immediate action, immediate activity while you're structurally cleaning up your investment, and then can sell the allowances again. Now, just to give you a little bit of a feeling of what this would mean from a financial number, we've run a couple of different indices with Solactive here. Now, some caveats for this chart. The numbers you're seeing here is back testing since 2018, where we compare the index performance with and without an EUA overlay. And this EUA overlay is calibrated to balance all scope 1 and 2 emissions that are represented by the index. The upper part shows you which share of your investment needs to be invested into EUAs in the first year and then today. And the lower part shows you how this would have played through in your financial returns and then tracking error. Now, let's first walk through the first two lines, because it's important to understand why this number goes up so much. When you buy an emission allowance, it does not necessarily create the same emission reductions every year. Generally, the slope declines. So you need to top up over time. In addition, your EUA position is calibrated based on volume, not on value. So you need to hold a certain amount of EUAs. And the EUA price has seen a stellar price increase since 2018, which drove the majority of this position increase from 2018 to today. So what you see is that the developed markets index for these are all large and mid-cap indices, needs a pretty low initial allocation of less than 0.5% initially, which grows then quite significantly, and accordingly increases your returns against that stellar performance of the last few years. Not necessarily said that this continues, even though forecasts suggest prices would increase further. Volatility goes down because it's an uncorrelated asset class, and you have, of course, some tracking error. If you look at an EU index, the allocation is slightly higher, mainly because the US tech sector is pretty overweight in the developed market sector. And again, a slightly higher returns profile and slightly less volatility decrease. Now, if you compare against this, a PAB-aligned version of the EU index, the allocation goes down. But at the same time, for example, volatility is only marginally reduced compared to the non-PAB index. And for the PAB index, it's a particularly strong story, because the PAB index, the key component of it is that emissions intensity decreases by 7% per year. So again, you're doing already your share, you're decarbonizing your portfolio fast, but then on top of that, you want to eliminate the remaining emissions that you're creating by holding an EUA position. And then no surprise, if we go to emerging markets, the overlay becomes much higher, and therefore the effect on returns and volatility, same way. So these are just some examples what you can do with this. You can run it across any portfolio of listed securities to calculate the financed emissions and emissions intensity, and then the EUA overlay. And you can use it for a range of strategies. You don't necessarily need to eliminate all your emissions. Maybe you just have an emissions intensity target in mind that you want to achieve, and you calibrate the EUA position accordingly. And of course, you can hold EUAs not just for impact, but also for the financial returns or to hedge the carbon price exposure of your portfolio. So there are more use cases that are not mutually exclusive, but there's a range of different ways how you can think about carbon allowances for mandatory carbon markets to hold as an investment for A, returns, and B, impact that you can divest later on. So this is a new asset class that we are opening up. There are already existing solutions based on futures. We're launching in 2.5 weeks an exchange-traded commodity in London, and a few weeks later in Frankfurt, which will allow you to have exposure to the physical underlying of the EUAs. And unless someone beats us over the next 2.5 weeks, it will be the world's first security of that kind.
Yeah, thank you, Jan, for giving the introduction. Maybe it's worth mentioning again, what is the main difference between the exchange-traded product you're mentioning and futures? So it's on the one hand physically backed, but what are the main differences?
Yes, thank you, Jenny. So on the first hand, our product is similar to a physical gold ETF. That means we are holding a physical EUA in our registry account that is directly linked to the issuance of one exchange-traded commodity unit. This has two implications. First, and with this product, you are sure that there is an emission allowance taken out of the market, therefore supply is reduced. Second, you have no roll costs. So if you're not holding a physical allowance but use futures, you are exposed to the contango. Contango at the moment is at an all-time low of around 50 basis points, but still it's quite significant additional cost that you have when you use futures. On top of that, depending on what kind of product you use for futures, you might be exposed to a negative interest rate on your cash and some swap costs and additional index costs, which all doesn't apply here in a scenario where you have a physical backed product. It's a UCITS eligible instrument that can be held by institutional investors and all kinds of other investors, also open for retail investors. And it will allow companies that otherwise cannot hold such an exotic commodity on their balance sheet to get exposure to this asset class.
No, that's very interesting. So when I especially think about the solution from a financial perspective, so we see a lot of rumors or communication around net zero targets at the moment, especially when we look into COP26 and the Glasgow Financial Alliance for Net Zero. There are many commitments out there looking how to decarbonize. Can carbon allowances or the exchange traded product be used to create such net zero products?
That depends. So when you look at existing frameworks and existing guidance of how to reach net zero, there are differences, and a lot of them are in development. So most of them take a rather negative position on carbon credits, which is offsets, because they fear that they are not having a lasting impact on emission reductions. Most of them, however, also don't take a strong position on carbon allowances. Primarily, so there's neither positive or negative view on those. We know from some that they're currently deploying consultancies to understand better how this asset class can be best used. And there's one exception. The Paris-Aligned Investment Initiative, which is led by the IIGCC, has put out a net zero investment framework. And they quite clearly distinguish between carbon credits, offsets, and allowances from regulated carbon markets, while dismissing the former and allowing the latter. So they are saying you cannot use offsets for net zero investing, but you can use carbon allowances. It's also fair to say that the wording is a bit unclear, so on a bit high level, so they don't detail it, and they are not endorsing, for example, this specific impact narrative. But that's the view on this. Just one point on the impact narrative. We did not make this up on our own. We used external parties like the London School of Economics and ICS, a research house, to provide studies on how this impact works and how this quantification of emission reduction works. And we will soon be releasing a white paper on both, also together with Solactive, on the methodology of how you can use EUAs as an overlay on top of equity and fixed income investments.
No, that's very helpful. And I think especially the academic side and looking into this from a research perspective really helps to make it a credible investment solution. Within the Q&A section, we also have received the question about the cancellation and what happens if you divest after a few years. I think you have explained it already, but is there also an option to cancel these emission allowances within the product, or do you just go for the MSR at the moment?
Yeah, great question. So it's not straightforward because it's so different to what you heard before in any kind of carbon product. That question makes perfect sense, right? So again, you are having an impact even if you're selling, because during your holding period, carbon allowances were canceled for you. You didn't cancel your own allowance, but the regulator canceled allowances on your behalf that are directly attributed to the investment of your allowance. So that means that you do not need to cancel your own allowances, but the regulator does it for you. Now, just one word of, so you can also, if you don't divest from your EUA allowance and keep this temporary emission allowance that we saw, let me just go back a couple of slides, that we saw here on the left-hand side, the blue temporary reduction. If you never sell your EUA allowance back to the market, it remains permanent, that you can do. But just one word of caution, don't cancel your EUA yourself. Because if you are canceling your allowances yourself, the regulator will add an additional allowance back because of the way the market stability reserve works. So if you hold it to eternity, great. You create even more impact. And as a side effect, as long as you hold the allowance, the MSR creates more and more and more and more emission reductions as you hold it, but don't cancel it.
That's a very good advice, and I think a very important one as well, as these mechanics are very complex and very hard to understand from outside perspective. Looking into minimum holding periods, is there also a minimum holding periods which is required to get this impact, or can I game the system and hold it over a specific period of time? No, this is very much a product that is for a long-term oriented investor build. So you need to hold your allowances at least for 1 year, since the market stability reserve is just assessed for after 1 year that you have an impact. So that's the minimum holding period to create impact.
We should also be fair here. These are stylized examples that assume a slightly simplistic view of the EU ETS. So it's not necessary that if you take permits out on day one, in the same day the emissions are reduced, because companies just need to surrender allowances on an annual basis. So there is a little bit of slack here. I made it a little bit more simple to make it understandable, but there are some margins here in it as well. But overall, if you want to create impact, you need to hold it at least for 1 year.
Thank you. I think this is also very important, and again shows that having the short-term effects, which the regulator don't want to see, are not really incentivized also by the MSR and the impact story. Looking into the prices, so driving up prices on the one hand brings us closer to the 1.5 degree target, but it also makes lives more difficult for the companies within the EU. Have you assessed if it would be a high disadvantage for companies within the EU increasing the values against companies which are not covered within the scheme?
So we haven't, but thankfully academics have. And yes, it's painful for European industries. So for the last, there is until 2018, when you looked at studies of carbon leakage, that's the idea of relocating production from inside of Europe into countries outside of Europe to essentially create emissions where there is no taxation or pricing of carbon emissions. Hasn't really happened. There's no really good, strong evidence for this. However, we should also say carbon prices were very low for this period. I said earlier about this lost decade. That's exactly it. Since 2018, we see carbon prices going up significantly and now trading at 65 euros. That's a significant burden for some companies. So the EU is reacting. On the one side, they realize that this is the price we need to decarbonize fast, but they also want to protect industry. So they came up with a concept that's called carbon border adjustment mechanism, which is essentially a carbon border tax. So every producer of energy intensive goods that wants to import or export their products into Europe will face a tax equaling the carbon footprint of that product times the UA price. That creates a level playing field. So that if there's a steel maker from Russia and a steel maker from Europe, and the Russian steel maker faces a carbon price of 0 and the one of Europe of 65, the steel from Russia will be taxed with 65 euros times the carbon footprint of the steel that is imported. But now guess what? Vladimir Putin all of a sudden becomes quite popular, becomes a tree hugger and is creating a carbon price in Russia. And why is he doing this? Because he doesn't want that the Russian steelmakers pay the European Union the 65 euros. He says, well, if we need to pay our price, then they should rather pay it to the Russian government. As said earlier, by now, quite cool source of revenue for governments. So this has two effects, these carbon border taxes. It protects European industry from carbon leakage, and it bullies / incentivizes other countries to adopt similar carbon legislation like Europe. And Europe is not alone with this approach. The UK, Canada, and Japan are all quite serious about introducing carbon border taxes, leaves the US, which wants to introduce a carbon border tax, plays in well with the narrative to protect against China, but can't because they don't have a domestic carbon price. So this is where the US sits. They're sitting in a difficult place where they would like to do this, but on the other side to do it. So geopolitically, it will be quite interesting. The EU hasn't enacted this tax yet. They're debating it as part of the Fit for 55 package, but whether this will geopolitically go through. And this is why I think, for example, the G7 meetings over the next few years will be much more interesting than the COP. The chart I showed you earlier on, the plus 5% till 2030, that's the COP process, that's the UN process. So the G7, I think, if they align and can make a carbon border tax happening that is aligned between them, it could be a very powerful tool to get the rest of the world aligned. So sorry, that was a bit of a detour on an additional topic, but it's heavily interlinked.
No problem at all. I think you also mentioned the two big elephants in the room and elaborated on the US already. China also has a big carbon trading scheme by now. Could you maybe give just a short overview on what we will expect from this scheme, because it will be the biggest one in the world once it's really live and acting?
Yes, let me just stop sharing my screen so you can see us better. China has created, is for years trialing emission trading systems in their provinces. And just interesting side note to put China in the right place, provinces could apply for being pilots to the emission trading system, and the dirtiest one applied. So what does this tell you? For Chinese politicians, it's a way of showing courage, showing proactiveness if they reduce emissions fast. Now, Since this year, China has a national emission trading system, which covers only coal-fired power plants in China, but still almost 3 times the size of the EU ETS. It's not very stringent. It's essentially a benchmark and trade system, which means there's not a finite amount of allowances, but depending on how much power you produce, you get a different amount of allowances allocated. So it's not very stringent, and the price is consequently very low. But to the credit of the Chinese government, it's probably a smart way of trialing the rules, of gathering data. The EU did the same thing from 2005 to 2007. They did a 3-year trial period, which was urgently needed. It was pretty difficult first few years, but they learned a lot from it, and then they created a much more stringent system. So I believe the Chinese want to do the similar thing. Have a national emission trading system now, mainly for data gathering and getting people used to the system before they dial up the mechanism, expand it into all power plants and all energy-intensive sectors, and then show real leadership and drive down emissions fast. So I'm pretty convinced it will become the largest market at some point. At the moment, by scope, it's already, by liquidity, nowhere near the EU ETS. Second to the EU ETS is the Californian market and the East Coast market in the US called RGGI, Regional Greenhouse Gas Allowances. But China will get there at some point.
Thank you. I think before we come to an end, maybe 2 short questions which are still open. So on the one hand, EUAs, they are also investable for everyone, at least in theory. What is the advantage of having an exchange-traded product and not an account registered with the EU?
Well, be my guest in setting up an account in the EU registry. It's not impossible, but it's a pain. So that's point one. It's not easy and straightforward to create an emission reduction credit. These registries were built for polluters, not for Jennifer Nerlich creating its own personal account or Jan Ahrens. Now, the second point is that for large investors, it's pretty difficult to hold a physical commodity on their balance sheet. For all kinds of regulatory and financial reasons, it's very difficult. There are not a lot of banks out there that can trade physical emission allowances, simply because it's really expensive and really difficult to do. So the reason why we exist is because this hinders all these large investors to enter this market. The biggest winners, the companies that made most profit in this market by speculating and trading on it, are the biggest polluters, because they are comfortable in navigating volatile energy and commodity markets. They have the trading operations for it, and they had the market access. So the big utilities, the big oil majors had the biggest emission trading desks and were making significant money because they were on their own playing ground. They had no competition from somewhere else. So we're democratizing access to some extent. We're challenging them on their home turf and making sure that other companies can join, that have the skills and the money to make this market more efficient and get the price where it's supposed to be.
Thank you. And the last very short question. So will there be a minimum investment amount for the EUA ETC?
No, that's quite a good question. But since it's an exchange-traded product, everyone can trade it. So it's a retail investor, you and me and everyone in the audience could buy it. It's through your normal broker account, and at the moment the price of an EUA is 65 euros. So it's that ballpark that you face. So that's the minimum investment threshold if you want at the moment. There is not a fraction of an EUA available, but that's it.
Yeah, then thank you very much, Jan. I think it was very insightful. We learned a lot about the mechanics and also about the impact story. When there are still open questions, please feel free to send over emails to either Jan or myself, and we're happy to set up also additional meetings. For the time now, I want to thank you everyone for attending today, and we will make a recording available. This will be published once the ESG webinar series of Solactive ended, and we will continue with the next and last webinar next week, which is on natural capital, where you get insights on how you can measure it and also integrate it into your portfolio. So thank you all, and have a good day.
Thank you for having me.